major theme is still underinvestment for a decade or more. And that means that the entire market will turn towards growth. And when it turns towards growth, it turns towards the junior market.
Even for us, it's not a short-term thing. We're not looking for battery metals in the next year or so, but we're looking to try and switch into finance for battery metals for a long-term future. I mean, I think it's inevitable.
With regards to some of the volatility on the battery metal side, I think it's really quite interesting. As investors get more, their understanding increases. They are going to be, I guess, flipping somewhat into certain metals that may be more prevalent than others.
But over duration, I think we're in a fabulous opportunity for junior mining companies.
This is the Mine Finance discussion for one-to-one mining investment EMEA online. Welcome viewers who might be catching up on this video content. We're going to be talking trends in mine finance at this interesting point in the industry cycle. To introduce my guest panelists, I have joining me Matt Fifield, who is managing partner at Pacific Road Capital, a large institutional private equity fund manager. Mark Tyler, London representative at Auramet. Auramet's a specialist finance provider, metals merchant and advisory house with a long track record within the sector. And David Bellingham, managing director of HCF International Advisors. HCF are a leading independent corporate finance advisory based in London with a primary focus on mining and metals sector. Gentlemen, thanks very much for providing your input and taking time to chat with me today. Matt, perhaps I could start with you. How has the commodities boom impacted mining finance, and in particular finance for junior companies? What's the view from you down in Sydney?
Thanks, Adam, and thanks for listening in today. Just getting a little bit of feedback. Anybody else? Okay. So broadly speaking, when it comes down to the commodity markets from about October of last year, what we've seen is unabated enthusiasm from retail and institutional investors. And you've seen, in particular, a trend towards widely available equity financings at all stages. But in particular, in comparison to the last couple of years, you've seen a lot of generative exploration raises. And that, I think, is a sign of the times where we are right now. People are valuing, in fact, pounds in the ground and growth potential over cash flow in some ways. So strong commodity prices have led to some of this activity, as has, if you recall back last year during the height of COVID, gold had a nice run. People took their profits out of gold, put it into industrials, critical minerals, and battery supported. I think that the single biggest thing happening right now with regards to access to finance is the persistent and consistent stimulus that is occurring across the entire batteries and EV space. And that's opening up all sorts of paths of partnership and sort of trend acceleration. And so people that are in that space have wide open registers. Things that are hurting financing to some extent is it's a very immobile world. It's hard to get from across a border, from one border to another. There's still a lot of restrictions. So the ability to move around and take on board what I would call larger financings that are less liquid. Liquidity remains an important feature of the market right now because the ability to do due diligence in a deep dive kind of a way is still constrained. So what you're seeing is, retail, small institution, smaller equity check support, a lot of it, which means you can do quite big raisings into immature companies, and then to mature companies can do whatever they want right now.
Yeah, that's very succinct and excellent rundown. Thanks. And so just to hone in on some of these less liquid financings you mentioned, that's sort of hurting the finance process. Do you see this really picking up this year as we're close to sort of a higher level of vaccination and travel starting to come back in certain regions? Do you think there's a lot of that due diligence basically backlogged up and ready to go?
Look, on one level, people have learned to live within the constraints of low mobility to the extent that they have. The expectations here in Australia are for honestly, a very prolonged hard border, which will make it harder for cross-border deals and illiquid cross-border investments into and out of Australia, unless you already have a team on the ground that you trust and has decision-making capability. And the same is kind of true in Canada. That will abate over time. What's suffering is once you get out of areas that have large capital markets and you start getting into countries that are a little bit more off the run. I think it could take a while for people to be comfortable that they're going to be able to go somewhere and not in effect get stuck or impacted by travel restrictions on the way back. So I don't think that it's a 2-month, 3-month issue that's going to solve itself over the summer. I think what you're going to see is progress towards a destination, and it'll be a little bit of a gradient. There's some strong cash flows, and we haven't really seen cost escalation to the degree that you would expect. There's a lot of cash flowing around, and that M&A and or JV funding is going to be coming across in stake buying. I'm going to buy 10% of this asset or 20% of that company, and you won't see the conclusion of that M&A in terms of 100% buyout or more deep commitments until people have been on the ground, been able to test their growth theories, and have the freedom to move their teams back and forth to complete that due diligence.
Yep, excellent. Thanks for that. That's a good understanding of how it's playing out. Mark, let me turn to you now. Echoing some of the points that Matt's made, it's interesting. Some trends accelerated, others becoming perhaps a little bit more difficult. How do you see the state of play overall at the moment?
Yeah, look, I think firstly, with respect to movement across borders, I think that's true. I mean, everybody's sort of stuck. It's very difficult to get into countries where the vaccination rates are low and come back into countries where the pandemic is over. But what we are seeing is places where it's possible to get a team on the ground. For instance, we've been looking at deals in Brazil, and there's quite a lot of engineering expertise in Brazil, and there's a lot of people with contacts with consultancies that they trust and know out of Brazil. So while it's not possible to get the mining team from the head office, it's possible to get somebody in and have a good look before, and make a decision. So in some cases, it's possible to get things done. I think where you would struggle is places where there isn't the engineering expertise on the ground, or there isn't an ability to ship in and out. I mean, what you're seeing, for instance, in Africa is a lot of the African countries can make use of engineering expertise out of South Africa and that sort of thing. So I agree with Matt that it's very difficult to get the whole hog done, but in some places it is possible to get things done, and we're seeing people getting deals, progressing them using expertise on the ground. I mean, maybe Dave can give us some background about that as well, and you should have some contact with the engineering guys and be able to tell us what they're saying. Yep.
David, what's your view on sort of mobility and sort of making things work in terms of leveraging an extensive network to work around some of these restrictions?
I think it's very important for due diligence teams to be able to get on the ground and actually see the asset, see the management. So I just second what Matt's saying. I think people still have that desire to make those investments, but ultimately they will need to be able to do their proper due diligence. And COVID has impacted things, and as Mark says, people are getting more and more innovative in how they do their due diligence, but ultimately people still need to do the level of due diligence that makes them comfortable to invest. So maybe the innovative route is going to be a smaller investment, as Matt said, and then find a way to do that proper due diligence before you make the full investment.
Yeah, absolutely. How do you see the sort of other trends within the sector that were mentioned playing out? So, for instance, is it easier to raise for someone that's pushing battery metals at the moment, or base metals, as opposed to precious metals? Or obviously, it's very case by case. But are some of these broader trends, making a more favourable case for certain junior companies, for instance?
I think that's absolutely true. I think even we're heavily exposed to the precious metals, but in particular it's the platinum group metals. In the long-term future, the platinum group metals is tied up with combustion engines, and so for us, it's not a short-term thing. We're not looking for battery metals in the next year or so, but we're looking to try and switch into finance for battery metals for a long-term future. I mean, I think it's inevitable. I don't think it's a good story at the moment, but still, I was looking at the registration numbers in the US in the last 3 or 4 months, and battery electric vehicles have the registrations of new electric vehicles in the US has gone up by 66% in the last couple of months, but it's still only 1.6% of total vehicle registration. So it's growing quickly, and in the long term, it will be something for the future. And I think you are seeing people taking long-term positions in that, but for us, it's not something that we're interested. I mean, and it's something very different for us, but it's not something we're going to be piling into in the next year or so.
Yeah, certainly. Well, you mentioned PGMs. PGMs have got an interesting position in that there could be a light at the end of the tunnel in hydrogen or hydrogen fuel cells in terms of the application there, replacing perhaps where the internal combustion engine might start to tail off towards the end of the decade.
Yeah, look, I mean, we did quite well out of the non-platinum PGMs, palladium, and in particular at the moment rhodium, which is in really short supply, and so we do well out of that in our trading side. And so I think for platinum, there is a future for platinum, but less so for palladium, which is probably the biggest volume of the metals, although not the highest, not the highest revenue. And so, I think it's got a bit of an unclear future. And I mean, I don't know that there's a lot of people in going into production in the short term in platinum, but there's definitely there's still a lot of interest in platinum exploration, particularly in better jurisdictions like Canada. We're seeing a lot of money going into the Canadian PGM industry, exploration industry, and also in Europe. So we're seeing some money going in there.
David, how are you positioned with regards to the battery metals or the industrials? Are you seeing more activity or more appetite in financings tailored towards these metals, or is it something that's not so much a factor for you?
No, I think it's a big market, and it's exploding really. I think as Matt said before, the junior market there's a lot of confidence back in the junior market. So I think the public equity raisings last year was something like 10 billion, whereas in the middle of the decade, the last decade, it was averaging about 5, 6, 7. So part of that is obviously equity investors are coming back into the market, maybe after licking their wounds halfway through the last decade, but ultimately they are coming back. But I think it's also in part because of the electrification evolution. There used to be gold, and now people are seeing that you need steel to make wind turbines, you need rare earths, and you need copper to make solar, and you need lithium to store it all. So I think very much there's a more of a familiarity with some of these other commodities that previously 5 something years ago people didn't understand. And I think people are buying into the fact that that now we need these other commodities that you can hardly pronounce sometimes, but we need these other commodities to evolve and to become to get those environmental goals.
Certainly. And coming on to the environmental element or the sort of sustainability and this whole ESG piece that has, in some respects, challenged the amount of capital that can go into extractive businesses, but also might make someone that's producing a sort of a transition metal or a battery metal or something that's going to lead to a greener economy, might make that a little bit more attractive as an investment. How do you, across the panel, see the sort of the green narrative and sustainability being carried out throughout the industry, and that's whether that's in terms of how the mining companies are enacting it, but also in terms of where the capital can go or where the capital flows want to go. So I want to tackle that.
Well,
I'll take that. Well, you go, Mike. That's fine.
No, I mean, I think what you're seeing, I think the most stark result of that is the absolute inability to finance coal projects. I don't think you could actually finance a coal project anywhere in the world at the moment. You know, and it's even difficult in places where the country depends heavily on coal production in order to keep the lights on, like in South Africa. So I think that's been a massive change, and that's driven by the people that invest in the industry, not so much by the guys who make the investments, but by the pension funds and so on that raise the money for that. I mean, I'm not sure that we're seeing a stampeding into, you know, people are making investments just because of the green, you know, an angle or something like that. I mean, I think people are investing in metals that have a green future, but I don't think it's specifically with the intention of changing the production rate. Sorry, David.
Yep.
Oh no, I was just going to say that with regards to ESG, it's been quite a fascinating, I guess, evolution in itself. Very much 10, 15 years ago, you were talking about the footprint of a mining company and how big is the hole and how much is that going to damage the environment. And then ultimately, it then went on to a more of a social license to operate, and how does the mine sort of fit within the community and does it benefit society as a whole? And that was just becoming more and more, I guess, onerous on mining companies to be able to, you know, to get their social acceptance. And now there seems to be a big turnaround and more of a holistic approach on the entire carbon value chain. And ultimately now people are seeing that you know, metals are potentially part of the solution, part of the enabler with regards to environmental awareness. And there have been investments into you know, clean environmental vehicles that are purely focused on this type of thing. I think we had the Vulcan Energy, which is trying to do the world's first zero carbon lithium hydroxide product, and that was oversubscribed by an ESG fund that was managed by Goldman Sachs and Canaccord. So, as Mark said, there's not a stampede, but it's certainly starting to happen where people are being influenced by the environmental credentials, and they're becoming more confident and more, I guess more, they're finding ways to support it, and that's happening.
Yeah, there seems to be a recognition for this transition that's needed. Do you find then that sort of splits the market in terms of junior companies? You know, you've got some that are really sending the right signals, they've got all the data available, but then there's others who might not be necessarily not ticking the boxes on ESG, but it's harder to get that data, or it's becoming a harder process for them in terms of their reporting standards.
Well, I think there's a big framework now that people have to comply with, and ultimately everyone's trying to do that. And there's always going to be the groups that are just trying to tick the boxes and trying to get as much from what they can from the new evolution. But there are also the other groups that actually believe it and are trying to do the best they can with the framework, but also they are legitimately trying to improve these aspects. And I think that's a real challenge for investors to try and find out who they want to invest in, rather than just making sure that the boxes are ticked.
Yep, certainly.
Look, I mean, we're just from the social side. I can't really talk about the emission side of things, but from the social side, our experience has been that, while it was true in the past, people wouldn't take the social impact of their project that seriously. But what we've seen in Africa and in South America is if you don't get it right, you can't operate. And it's now a hugely critical thing for everybody to make sure that, you may be able to get away with I'm being a little bit naughty on the physical environment, having spills or something, but you really can't get away without treating the people, the communities, and the stakeholders around you properly. And so, that's become a hugely important for us as well, just as much as the physical environment.
Yep, absolutely. Stakeholder engagement is vital. Matt, do you have any other comments on ESG? Obviously essential within all kinds of forms of due diligence, but is there something particular where you see ESG has been amplified at the moment?
Thanks for the question, Adam. From my perspective, we've been a leading voice on this for probably 4 years now. Signed up to UNPRI. I've been developing our responsible ownership initiative. The reason that we're doing that is, in part, it's because it's good business for us, and it helps us connect with the value sets of our pension funds and endowments, and it's in line with the Sustainable Development Goals. And there are a number of reasons to do that. The other thing is quite personal, though, which is that we have seen consistently that companies that are performing well along ESG metrics are better positioned for growth. They're better positioned for acquisition. They're better positioned to attract capital, both in the equity markets and in the debt markets. And if you step back, one of the most important things that's going on right now, right, seeing a parade of companies that are all going to be net zero. 40 could be 2050, but effectively the world's corporations have voted and listened to the Sustainable Development Goals and their shareholders and their customers and said, this is the direction that we're going. Okay. Well, it turns out that with manufactured products, the range of your scope 3 emissions is something like 65% of your scope 3 emissions, and it's a range for every product. 65% of your total emissions are scope 3 emissions. So from scope 3 emissions, mining companies need to look very critically at what value they're providing their customers, and effectively, one of the greatest areas of gains that can be made are value of your product in light of scope 3 emissions. And so that's a huge change, massive from even 2-3 years ago. And what's been driving it is everyone is making these commitments and they have no idea how to fulfill it. So the innovators will find markets and strategic partners and capitals, strategic capital, and the laggards will be left out. And that is the battleground of today. It's one of the most interesting things we're seeing consistently.
Yeah, it's interesting how the sector will perform and who will be the outperformers within that. It's a great metric, and it brings me on to my next question. Actually, I wanted to ask you the finance providers, other than just the capital that you provide for these companies, you obviously provide a whole range of expertise, and I just wanted to get your thoughts on exactly what are the essential elements that you provide to the junior mining companies in particular, beyond just the dollars.
I can chip in there because we provide a range of services.
Yeah.
In addition to the money that we provide, obviously we provide advisory services. We do, while we're not corporate finance, we don't do M&A stuff a lot. We're very well connected in the industry, especially in the junior mining industry. We've been, the people involved in the company are all long, been around a long time, so we know a lot of people. We can do quite a lot of advisory work in terms of raising debt, but also in putting people in contact with other partners that they may be able to work with. And then obviously we buy metals, and we have our relationship with the where we buy for our account the precious metals, but we also work closely with ocean partners and willing to buy and trade the base metals out of that. I think other than that, I'm not sure there's a lot more we can do, but it's quite a wide range, I think.
Yeah, certainly a suite of qualities and services. David, with HCF, you're providing a great deal of sort of technical services, but also sort of in-country expertise as well. You're fully embedded in a number of jurisdictions, right?
Yeah, no, that's right. Just to be clear, HCF, we don't provide capital ourselves. We source capital, but we effectively advise companies on how to get themselves into that position where they can raise that construction capital, and it's quite incredible. We've all seen the numbers. Like you've got from 10,000 or so potential deposits, you get one mine, and so throughout the process, a mining company, once it gets to the DFS stage, has done an amazing job of de-risking itself from a technical perspective. And ultimately, then you start to reduce that risk on the technical side, but then you start to increase the risk on the financing side. And then you've got stuff like the offtakes, procurement strategy, whether the DFS is bankable, whether that cash flow profile is bankable, whether it's going to actually work. And so ultimately what we do at HCF is we try to manage that financing risk. So it allows the mining company to continue doing what it does best, which is de-risk, build the mine, make money. And ultimately what we do is we try and transition that process such that they can raise that capital and build their mine as efficiently as possible.
Yep. Excellent. And Matt, obviously you talked about some of the more personal responses to ESG, and that's obviously an attribute itself outside of providing the capital. But is there anything else? Private equity takes a longer term view. You hold companies quite close and take quite a hands-on approach with management, as far as I understand.
Yeah, look, one of the, we're concentrated investors. We can be light touch investors in some circumstances, but other than that, normally we're there in partnership with management. We have the advantage of having made a lot of mistakes and battled our way through them. So we can sometimes, as owners, and we see those mistakes coming towards us. And so we're able to, steer away from them. The other thing that's very interesting is in the life cycle of a mining company, you go through a series of positions. And what you find is that the team that found it, discovered it, sometimes isn't the right team to permit it, sometimes team to actually get into stable operations and work on operating costs. And so an organization, as it grows from one point to the next, has to go through a series, quite unusual, but it has to go through a series of evolutions where it effectively recreates its operating model in a new way. We have a lot of experience with that. And so part of that's about people transition. Part of that's about just recognizing in preparation, this is what's coming towards you. You need to start planning for this. And that's people, thought process, and all of the rest. So look, our team is full of seasoned operators. We sometimes have drop-in talent that we'll put in, but most of the times we're acting as mentors and coaches and aligned investors saying, this is coming towards us. Let's get ready for that next phase. As I talked about ESG, that's just one persistent thought process that you hold from beginning to end, but it's also still, getting yourself ready for that next phase. Same thing is true with operations. Same thing is true with capital raising. So we're kind of in your corner, helping you stabilize as you grow.
Yeah. Excellent. And just to cap off, I wanted to get thoughts from everyone on sort of the state of the sector at present in terms of how have you seen the junior tier performing? Obviously, we've had a good period, and we've talked about how equities markets have opened up again. There's a lot more forms of finance available, ostensibly. But do you believe the companies have responded well to that? And do you think it's a period maybe coming up where financiers can be a bit more selective? We've had all ships rise, and now actually we're going to be going into a slightly cooler period where you have to be a bit more selective around the companies that are going to outperform.
Adam, we're going to see a choppy market, right? When it comes to, say, energy transition, it will both go faster in the long term and slower and choppier in the short term. And so the demands that are made on the supply chains are just going to be really volatile. Right now, we're seeing pressure on iron ore prices. We're seeing down, we're seeing pressure on gold, up. So you should expect for the next 3 years, you're going to see lots of little micro windows open and close and a lot of volatility that's going to happen. The one thing that is, so through all of that market volatility and all of that price cycle volatility, the one thing that remains constant and true is that for the last decade or more, this is still a supply side story. There just has not been enough generative exploration. There's not been enough project development, and things are longer and harder. And so the capacity to respond is merely muted. I think it's a fabulous time for junior market investing. I think that if you need to be prepared for that volatility, but if you're looking on a longer cycle, 3, 4, 5 years, what tends to happen from where we are is it'll underperform, it'll overperform. If you can time it, you're a genius. That's great. If you're in it on a longer term, the major theme is still underinvestment for a decade or more. And that means that the entire market will turn towards growth. And when it turns towards growth, it turns towards the junior market. And that's, exploration, PFS, developers, single asset companies, all of those become targets for consolidation or further out valuation. Just make sure that you understand where you are in some of the choppy volatilities. It means there's lots of buying opportunities, but over duration, I think we're in a fabulous opportunity for junior mining companies.
Excellent. Yeah, it's good to be hearing that. Mark, sure.
No, I mean, what's surprising us, and possibly it shouldn't, but what is surprising is the enduring strength of the precious metals market. So it was the first of the metals to come back. But even as people have moved out of that and found other opportunities, there's still an enormous amount of strength left in particular in the junior precious metals market. And it's always acted as a sort of a place, a refuge for when things go, when in volatility, people, in the industrial metals, they move back into precious. And so I think that's a great thing, that there's the enduring strength. And I think over the last 5 years ago and longer, the last downturn in the cycle was driven by people not being interested in precious metals. And I think that had a huge impact on the industry in general. And the current strength of it bodes well for the market. I think we'll be able to handle the volatility with that sort of interest.
Yeah, excellent. David, do you want to just cap us off?
Yeah, sure. No, I'd echo what Matt and Mark both said. Certainly with regards to some of the volatility on the battery metal side, I think it's really quite interesting. As investors get more, their understanding increases. They are going to be, I guess, flipping somewhat into certain metals that may be more prevalent than others. So we saw the other month where we've got a potential technological advancement where you can convert NPI into potentially nickel sulfate, and then you've got nickel dropping by 15-20% in the space of a few days, and now we've started to work out that maybe that process is possibly not that environmentally friendly, so nickel goes back up again. And then similar to cobalt, where the cobalt obviously chain comes from parts of the world that aren't as familiar as others, so therefore there's a lot of talk from the battery makers that we're trying to reduce the content of cobalt in the cathode, and then that has maybe precipitated a bit of a drop in cobalt over the last sort of year or so. So it's really going to be interesting how the understanding of the, I guess, the electrification evolution transpires, and that will influence where people are going to want to invest, and that will bring about its volatility. So it should be fun times ahead.
Yeah, certainly.
David, I agree with you, which is that changing battery chemistries over time and changing consumer needs over time is going to be a source of frustration and both concern and outperformance within the market. The thematic is there. You need a lot more nickel. You need a lot more cobalt. You need a lot more anode material, and so the thematic is very strong. but there's a lot of noise that I think will discourage some generalist investors until they're looking in the hindsight and saying, wow, look at that. That's some of the opportunity for people that are willing to do the work, guys like you.
Yeah, it's interesting that generous capital coming back, but do you think the performance of the sector might, if companies are performing a lot better than they had certainly in the last cycle, that can help convince generalists that this is a good sector to be in, as well as the thematic element?
I mean, the generalist sector tends to, look at historical returns and extrapolate them, to the future, or to look for thematics around which to come in and come out. I think one of the most interesting things that's happened on the equity side is the rise of passive investing and index investing, as opposed to specialist managers that are buying into development stories.
Yeah,
And that's something that's really important for junior and mid-sized companies to understand, is that there's a very limited pool of people that are interested in what you're doing with your company, and there's a much bigger pool of capital that is interested if you're in an index or not.
right.
And so therefore positioning your business and understanding how to operate within a fundraising environment to take advantage of that rather than be frustrated by it is actually very important.
Yeah, that's an excellent point. Very good. Okay, well, gentlemen, that's taken us the time, and thanks very much for a really good rundown of where we're at with the industry. Competitive, but also excellent time, nonetheless, as some of you have stated. So thanks very much for providing some insights for one-to-one, and look forward to getting this out to the viewers over the next few days.
Thank you very much, Adam.
Thanks, Adam.
Thanks, guys.
Thanks, David.
Pleasure to
Thanks,
be
Mark.
here.